Hello, everyone. Welcome to the show. I'm your host, Hiran Amin. I like to kick things off with a famous fable that holds an important lesson for options traders. It's called The Tortoise and the Hare. It's about a race between those two creatures. Long story short, the tortoise ultimately prevails with his slow and steady approach. And that's something option traders on a budget can take to heart. Some might feel that they may need to place higher risk trades that require a lot of upfront money to earn any meaningful amounts of income, but that may not always be the case. Instead, they can consider lower risk trades with a high probability of success that don't require as much upfront money. An options trader can use them to slowly but surely move closer to their goal, just like the tortoise in our story. Over time, those potentially small but consistent profits can add up to a steady stream of income and help grow a portfolio over time. This approach is a favorite of today's guest speaker. So let's hear all about his approach to trading options without staking a lot of money. So joining us is Henry Moldavskiy, founder of Invest with Henry. Henry, thanks so much for joining us and swinging by to chat. How are you doing today?
Doing very well. Very excited to talk about option trading.
Absolutely. I'd like to just start off by first just getting you to share a little bit about your options trading philosophy and why you like to trade options for income specifically.
Yeah, so I've tried a lot of different option strategies in general, and buying options has been very inconsistent. And that's why I've been teaching for a very long time to basically sell options for consistent income because I've been able to travel the world. I've been able to do a lot of things because I have consistency. So I always tell people I'd rather make 100 or $500 a day. That's much better than one day making 2,000 and the next day you lose 1,900. Like that's not fun at all.
Absolutely. Now, you have an interesting backstory as well. You previously did work for Goldman Sachs, which, just to introduce to our viewers, is one of the top investment banks, dare I say, not only in North America but the world. So, how did that experience shape your options trading style now that you share with the rest of us online?
So yeah, I was in the wealth management department in Los Angeles, and I definitely got to learn a lot. But most of it was kind of like self-taught, because so I was using a lot of Goldman Sachs resources. They have a big research platform, which is basically just for high net worth individuals who have like 10 million plus nowadays. And I just did a lot of research. I didn't necessarily learn anything hands-on there, but I had a lot of time and access to materials. So I kind of taught myself, and my strategy started to evolve because I had an internship before that at a hedge fund where I really learned about option trading. So Goldman Sachs is just more research and general insight into the market and different analysis in the stocks.
All right, brilliant. Now, before we do dive into our conversation, the meat of it rather, a quick note to our audience. We're discussing Henry's approach to options trading and some of the research criteria that he considers. However, there are many ways a trader could trade options on a budget depending on their unique goals and needs. So take our discussion as food for thought. With that said, let's get right into it. So, some investors might have the perception that they need to have a lot of money or a large portfolio to trade options to help generate income, but that's not necessarily the case. Why would you say that?
I had the same belief before I became a full time trader. I thought I needed like a lot of money, and yeah, I thought that was the limiting factor, but it's not. It's pretty much a myth. Anyone can actually start trading options, even with $50. So there's certain strategies like spreads, like a put credit spread, a call credit spread. Those are safe strategies, or fairly safe. You only need $50 because with spreads you can kind of close off the risk. So instead of like using a big strategy like selling a put, which requires 100 shares, spreads they don't require 100 shares, so they're very easy, and you can have a small amount of capital to get going.
And let's talk through some of the kind of preparation that can help option traders on a budget stretch their dollar. So, what are some of the top priorities for trading options without a lot of money, would you say?
Well, it's still all about risk management. So even if you have $250, you want to treat $250 like $250,000. You still want to spread it out as much as possible. Granted, 250 is not a lot of money, but you can probably have five positions that are $50. So what I would look at is just risk management. I would pick different stocks. So maybe you have some airlines exposure, maybe you have some consumer or technology or healthcare or financials. You basically want to just have some diversification, even if you're dealing with a small amount of money.
And I just want to touch upon the point because you talked about, I guess, limiting the number of positions, open positions you have. So I know you briefly talked about five. Is that kind of the number you look towards if you have a kind of a small account just in terms of management side of it?
Textbook, I studied finance in college. Textbook will say 12. 12 is basically diversified. And after that, you still get benefits, but it's a very big diminishing return. So I would prefer to have 15 to 20 positions in my portfolio. But if someone has a tiny, tiny portfolio, they're probably going to have to get by with five. And the way you can also deal with that is if you pick the large cap companies, they are in the, of themselves kind of diversified because they have like 10 businesses in one.
Right. Okay, that's a good point you raised. And also to speak to that point, when we talk about kind of assessing, because I know a lot of traders kind of say, look, this is my portfolio size. I don't want to spend everything towards options. I'm going to dedicate a certain amount. So do you have that kind of same view? Do you allocate a certain percentage of the overall portfolio dedicated towards your options trading? And if so, what would that be?
So me personally, I use options 100% of my net worth. So I have a $2 million portfolio. It's, I always show it on my channel and I'm very transparent about it. Everything is in option trading. And some people think that's risky, but the way I trade, since it's for income, it's very safe. And I actually do use margin in a safe way. Now, I don't recommend my students do that because margin can be very risky, but I've never had a problem. I've gone through multiple crashes and my portfolio has always done better than the S&P 500, even using margin and being 100% in options. So actually, I sat next to a really famous trader on Wall Street. He said options are safer than stocks. People can't wrap their head around that, but they are safer than stocks if you know what you're doing.
All right, yeah, we're going to unpack that hopefully by today, but I'm of the same view. Now, what do you look for in underlying that suggests to you that it might be a good fit for trading options then?
So all I really look for is liquidity. If it has healthy volume, healthy open interest, that's number one. And then I have to like the company. I don't necessarily look at hardcore technical or fundamental analysis. I do. I take that into consideration. But if it's a good company, if it's closer to a 52-week low, if it's not at a 52-week high, that's already a good candidate for me to start jumping into some value strategies.
Does implied volatility also factor into this at all?
Yeah, I take a look at it. I just want it to be medium. Too low, it's not attractive for option selling, and too high, it is attractive. But I have like I need to scratch my head. Like, why is this so high? Is it because an FDA approval is coming? Is it because earnings is coming? So I'm very cautious on it being too high or too low.
And just a quick note to our audience, if you'd like a refresher on some of the options terminology will be referencing, check out our video course using options for beginners. That's available in the Learning Center on Webroker and on TD's YouTube page there. And now you have some specific trades though that you mentioned that you like doing, and those are risk defined actually, and especially if on your budget. So you're a big proponent of call and put credit spread. So can you first take us through exactly how a call credit spread works?
Yeah, so basically, a call credit spread is kind of like selling a call option, except it's not naked. Okay, so if Apple stock's at 100 and you don't think it's going to go to 120, you can sell a 120 call. That would be a naked call option. A call credit spread is basically that, except now you're selling the 120 call, but you're covering yourself up. Here's the 120 call, and then you're buying a 125 call. And this gives you a defined risk and return. That's $500 worth of risk. Let's say you collect $100. Okay, so then now you're getting 100 for 500. It's really 100 for 400 because when you factor in the premium, that would be a 25% return, and that's essentially how a call credit spread works.
And I guess on a similar approach would be trading a put credit spread. So can you take us through how that one would work?
Yeah, so a put credit spread is very similar, but the reverse of that. So let's say we have Apple at 100, and you don't think it'll go to 90. You can sell a 90 put, and now to create a spread, you can buy the 85 put. Now that's a 90, 85, that's a $500 difference. And let's say again, you collect $100. So again, 100 for 400 of risk. Again, 25% return in that example.
Just so our audience knows, whenever you're putting on these credit spreads, you're collecting a credit which is going to act as your max gain in these situations. So in this case, it would be $1, and in the hopes that the spread expires worthless, you get to keep that $1. But in the event the trade goes against you, what is your max loss situation? So that means if the position moves down to your long strike price, that would mean you'd end up having to take a loss. And in this case, it would be the difference between what your spread is, the difference between the two strikes, in other words, which is $5, minusing that initial credit that you collected, which is $1. So in this case, it would be $4 as our max loss. And for this strategy, I guess the overall sentiment what the trader would have is almost neutral to that bullish move then when you're putting on that put credit spread.
So yeah, for a put credit spread, you're neutral. You can be bullish. You can even be a little bit bearish, as long as you pick a strike that is outside of the scope where you think the stock will be at.
What sort of profit loss ratio might you generally aim for if you were trading, let's say, a call or a put credit spread on a budget? Like if you're collecting a certain credit, I want to get this and take on a certain amount of loss. So do you have kind of guidelines to that?
So I usually aim for around a 12 delta. That's kind of like my sweet spot. So for me, I want to win at least 9 out of 10 trades, and my profit loss is hopefully over 90%. Even though the delta is 0.12, we all need an edge. I tell everyone that option trading is actually all even money. If there was a huge opportunity, it was obvious everyone would take that opportunity. So there's actually no way to really make money in the market. The only way is to have an edge versus other people. So, anyways, I try to have like a 4% edge or so. So I'll sell 12 delta options, but my goal is to win 92% of the time. So 92 versus 88 in theory. So that 4% is kind of like my small edge, and that adds up over time.
So what sort of target profile are you looking for to earn on credit spreads you trade?
I just try to make 1 to 2% a week. So in terms of my profit loss ratio, like how many trades I win and how many I lose, I actually don't really like focus on that hard because I have had months where I have won 99 out of 100 trades, but they were very tiny, low risk trades. I know a guy actually who trades like oil futures. And he has like 1 out of 100 wins. He loses like $99, but when he wins once, it's like $1 million, as an extreme example. So I don't really look at profit loss too hard, but I try to win 9 out of 10 trades. And then those trades are typically like 2% a week. So that's why my average return is like in that 1 to 2% range.
Now, let's talk about the next thing, which would be logical, is expiration. So when you're putting on these trades, what time to expiration do you generally prefer with these credit spreads?
Well, with spreads specifically, I like weekly trading and monthly trading. With spreads, sometimes I'll go out 6 to 8 weeks. And that's because every time you're trading, there is a bid ask spread. There's still some cost because there's a difference in bid ask spread. So I do like to do 6 to 8 weeks out. That way I can reduce the amount of trading I do because I'm not a full time trader. I like to only trade 3 hours a week. I'm more of a full time coach helping others rather than being at the computer trading all day. So I like to keep it very simple. And with spreads, I'll go out 6 to 8 weeks.
Henry, does that have to do more the fact that that's kind of when there's a lot of liquidity, and then you kind of see liquidity evaporating as we get closer to expiration? Is that why you're choosing those 6 to 8 weeks time frame?
That's a good point. Yeah, very short-term trading. Those costs add up. Liquidity could be different. Exactly. But someone that has like a budget, maybe they want instant feedback. They want fast feedback. They want to see how much they're making per week, and maybe they need that income to use it for their bills, for the electricity, groceries, etc. So 6 to 8 weeks or even shorter time frame could be very ideal for that type of person.
Along with the lines of expiration is strike prices. So how do you decide on strike prices you feel are relatively safe when you're setting up a credit spread? Now, I think you already quantified that for us a little bit. You look for those 12 deltas. Is that kind of your sort of goal whenever you're setting up these spreads?
Sort of. There's a lot to it. So there's 12 delta. There's also moving averages. There's Bollinger Bands. There's RSI points. There's MACD. There's a lot of different factors involved. And to be honest with you, trading is not a science. It's an art form. So there's also emotion involved. Sometimes I will emotionally feel this is out of the money enough, and I feel safe here. I'll look at the chart and say, hey, there's a double bottom. There's a double top. There's a certain pattern forming. So sometimes a lot of it is emotion.
Can you take us through Bollinger Bands and how they work at a high level, and why do you like to use them as a technical indicator when it comes to trading options?
Yeah, so I give this example a lot. It's basically a Bollinger Bands based on like statistics in the bell curve. And for folks that are not like super experienced in statistics, is if you're a man, you're 5'10", you have a son, your son's going to be about 5'10". If your son's 6 foot, it's possible, but it's going towards the right hand side of the bell curve. It's less likely. It's like maybe one standard deviation away. If your son is 6'2", two standard deviations away. If your son is 6'4" and you're 5'10", this becomes very extreme. And that's what the Bollinger Band is. It's basically telling you what is normal, what is about normal for average. So if you're a 5'10" man, you're not going to see a 4'8" son. That would be that the chance of that is like probably one in like 100 million. And that's the same thing that the Bollinger Band is doing. It's telling you where a stock is likely to trade between what prices, very similar to the height of a man's child. So I'll just look at the Bollinger Band. It'll tell me like kind of the peak and the throw here, and it'll either expand if the volatility is expanding, or if the volatility is not expanding and it's going down, it'll start to kind of go like that. And essentially, I'll just look at the bottom to kind of get entry points, or I'll look at the top to get exit points. So if it's above the high of the Bollinger Band, then it's just a no-brainer, and I'll end up doing that a lot more aggressively and be a higher delta.
And another quick reminder to our audience, you can learn about how other traders consider technical indicators in our technical analysis webinar series. You can find it in the Learning Center on Webroker and on TD's YouTube page. Now, Henry, back to our conversation. Option traders often like to close their positions before expiration to lock in a profit or minimize a loss. So, how do you decide when to close a credit spread out? Do you have empirical, again, are you looking at technicals again, or do you have empirical numbers on the high and low end?
I take the lazy approach. If I done my job correctly, I did my research correctly, I don't touch it. I forget about it, and I tell all my students to basically just relax, spend your weekly profits to have a good time with your family, your friends, etc. Don't worry about it. Leave it until Friday to expire, and if I did my job correctly, it's going to expire worthless. So I don't monitor it too hard. It's not like you can really predict the market, anyways. So staring at it is just, in my opinion, a waste of time. So I'll look at it the day before expiration, and then I'll make a decision, usually at that point.
Sometimes trades don't go always in an option trader's favor. So, for example, there's a term that's commonly thrown around when you're dealing with spreads, especially credit spreads, and that's pin risk. And what this means, just for our viewers, is that the short option is at the risk of going in the money, but the long option remains, quite far out of the money. What would you do, or have you come across this in your experience, and how have you dealt with it?
Yeah, so that goes into like the management of the spread. That's why I look at it the Thursday before expiration on Thursday. If it's in the middle and there's pin risk, honestly, I don't want to deal with the pin risk. So I just close out that position. There's just no point of having a headache over it. So usually I close out the position, or I will roll the position down. So if it's the 99, 90-85 put spread, maybe I'll go down to 80-75, something like that. So I usually don't like to deal with the pin risk because it is a significant headache, especially with some brokers. They will actually start touching your position for you without your permission. They'll close it out because there is a risk on their end.
That's right. Yeah, usually on expiry day itself, brokers really want to just get a handle of that. So, a good point you made there. Now, when it comes to it, when you say you close out, do you ever just manage the side that's just in the money? Is that what we're dealing with, just the short option, and we kind of forget about the long one if you're doing it, let's say, a day or a couple of days ahead of expiry?
I usually don't. I treat the position as one, so I'll always close both out at the same time. Because if you close one out, you end up losing money. And yes, your long call, your long put, let's just say on a put credit spread, let's say it's for a profit, but then the stock ends up popping up. You lost money on your short put, and then you might lose all the money in your long put. So this could become a huge risk. So I just close everything out at the same time. It's a couple $100 loss, which is nothing.
Yeah. So you're doing a clean break with it, not kind of legging out of that trade. So,
Right.
good point you make there. Now, at the top of our chat, we talked about kind of those criteria that you said, and so let me pick on one here. So as option traders who are on a budget, they might have the temptation to tinker with their option positions if they really feel anxious about the trade that's going against them. So what do you do to help you kind of deal with or help with those emotions when it comes to managing trading options there?
Yeah, yeah. So I really like this question because I know a lot of people they're looking for an answer. It's like, oh, I'm going to manage it this way, and I'm going to do a list of 50 things. It's like there is no such thing as a list of 50 things. And a lot of people think that there's a lot of management that you can do. There is not a lot of management. There's nothing you can do. You're taking the loss, or you're rolling the position. There's only like literally two options. The other option is to go cry, but there's two options. You close it or you roll it. There's only two things, nothing else. And in my opinion, I just close it for a loss. You can roll spreads though, and I think that's totally fine. I do it maybe 20% of the time. Just extra work for not that much gain. I typically don't really do anything. I just leave it alone. Again, if I did my analysis correctly, I just leave things alone. And that's kind of how I do the lazy approach to managing. If you're well diversified, you don't have to worry about it.
Now, how do you think option traders without a lot of money might want to approach trading credit spreads around major market events and earning reports, which can impact the implied volatility of options?
Earnings can be super tricky. I try to usually avoid it, but sometimes, I mean, for me personally, I don't know which direction it's going to go. I don't think anyone knows what direction it'll go. If they say they know, they're kind of lying. There is some indicators like the trend. So out of the past four times, if they're winning and they continue to beat, then they're probably likely to do that again. I also use AI tools like OptionsFi to see the likelihood of a beat. And I've also looked at, for example, I use that software for implied volatility move. So implied move, how much is it going to go? If it's very like small, then I might do some buying strategies. If it's very like large, I might do some selling strategies. It actually just depends on the implied move. So if it ends up having a huge implied move, it could hurt your credit spread and you can lose the entire amount. So, since earnings are so volatile, selling options during earnings has more inherent risk than non-earnings weeks.
Okay. And do you ever factor in stop loss orders when you're setting up these strategies at all? Just in case they're moving against you? Because I know you said you don't like looking at them. So are you automating any of this?
No automating. I think people think that's a smart idea. It's not a smart idea because option trading is very volatile, and oftentimes your stop loss could trigger by accident, and you end up getting out of a position that you did not want to get out of. So I hate stop losses, and I don't use them.
Okay. All right, Henry. Well, we're going to wrap our conversation there. Thanks for showing us your approach to trading credit spreads and making the most on a limited budget. Now, I wanted to take a moment to hop into Advanced Dashboard to show our audience how they could put some of your best practices into action. Now, as Henry had mentioned, one of the ways he likes to trade options when on a small budget is through the use of doing credit spreads. And we're going to specifically look at selling a call credit spread today. Now, before we actually demonstrate the trade, we're going to talk about the most important question is the potential way to determine our entry point. And we're going to be using one of the technical indicators that Henry talked about, and that is Bollinger Bands on the chart. So we have got loaded up DIA, which is stands for the Dow Jones Industrial Average ETF, and we're going to be using that as our example today. So I'm going to enlarge the chart that we have, and we're using Bollinger Bands. Now, Bollinger Bands is a technical indicator that informs an investor about the volatility of a security. And so it really tells us, in other words, how much the stock is going to swing from its average price. So when you've got it plotted into the chart, you're going to notice the Bollinger Bands has these three lines. This is known as the upper band up here at the top, the blue. The middle one is a moving average. So this is telling us about the average of the price, or the average price where it is based on 20 days of action there. And then finally, we have the lower band, which is the lower band away from the moving average. Now, this is a statistical measure, and it is based on two standard deviations away from the moving average. So in other words, it essentially tells us that 95% of the time, the price of the stock or ETF in question is going to be within these two bands, either on the upper or lower band. Now, it's not directionally specific, so it doesn't tell us exactly whether it's going to be up or down, but it tells us when you're using the study that we can almost say with 95% certainty that the price is going to be captured within these two bands. And this is where it's going to be helpful for us when we're selecting our strike price when we're selling call credit spread. So when you're selling a call spread credit spread, we are looking to be a little bit neutral to bearish on the security, and we really want to sell it outside of the range of where the stock is expected to go. And so we can see coming up right now, the Dow Jones is nearly trading at about that 342 level at the moment. And so if we're deciding which call we should sell, reasonably we can say with certainty over the past, year and a bit, it's usually tracked at the highest range as walk the band is so we call. So whenever it breaks through the upper band, you can think of it as being in this overbought territory, overbought region here. And it's really done it only once in that past year if we look at it, where it's actually gone up to that high price there, almost touching 346. But since then, it's never broken through to that. So when I'm selecting my call credit spread today, one thing I'll know is I'm fairly certain that that 345, 346 level is going to be a good starting point there. So this is what we're going to use as part of our metric. The other thing Henry talks about is he wants to see where most of the price action is within the band, and we can see it's concentrated around this area, that lower 340s to upper mid 330s there. And so we're going to be, again, we want to make sure and ensure that our call is priced quite away from that. So we don't want to be captured within those bands. And really, the upper band limit is that if we really want to be play it safe, 350. So now let's actually head over to our options chain. And I've got it queued up over here. I'm going to expand this. So we've got Dow Jones Industrial Average queued up over here. We're going to look at selling a spread. So that involves creating two legs as part of the strategy. So you have to select this multi-leg order to set that up. In terms of expiry, I'm going to choose about roughly that 40-day window right now is what we're looking at. So I've expanded that already up. And we talked about that 349 level. The other thing Henry talks about is choosing very low deltas. Now, delta is one of the Greek measures that tells us how much an option is going to move when there's a $1 move up on the stock. And so it also tells us the chance of an option going in the money. In other words, it's a probability gauge. So if you look at a delta, if you look, for instance, the 349, which is a 32 delta, tells us there's maybe a 32% chance of that option that can go in the money by the expiry date. So he likes doing fairly low deltas, and in fact, we're going to go as low as the 15 delta, in fact, just to be sure, because we want that better rate of success. So on the 355s, we're going to decide to sell this strike. Click on the bid to do so. So there's our first strike. We're going to now you can choose the spread however you want. So if you want to go further out, it's just depending on how much risk. Now, the wider the spread goes, it means the more premium you collect. We're going to limit ours to a 5 point spread. So in other words, I'm going to choose the next strike available, which is the 360, and buy that one. Now, the neat thing that dashboard does, it gives you kind of a rundown or breakdown of the information. So it says, look, based on the current credit we're going to collect, which is, we'll try and put a limit order of just say 50 cents right over here. We're going to make a max profit of 50 cents in the happenstance that the DIA doesn't get to 355 by 9th June. That's our ideal situation. If it ends up going all the way up and past 360, then that's a worst case scenario. We're going to be losing $450 on this trade there. And then it gives us a summary of the Greeks. Now, keep in mind, we have crossed and looked at a number of indicators to make ensure that we're outside of that band. We've also looked at the low deltas. So this is kind of that part and parcel where Henry attributes a lot of his success to not having to worry about this trade once it's set up there. Once you're happy with all the information, you can simply hit create order. It's going to bring the order entry ticket up for you here, and you're good to go ahead and send the order there. Hopefully, that demonstration gives our viewers a jumping off point to consider. Now, Henry, any final thoughts you'd like to share about trading options without a lot of money?
I think regardless of people's portfolio size, they should just focus on consistency, safety, and that's pretty much all what my strategy is about: safety, consistency, and as passive as possible, so it doesn't become a full time job. It's supposed to set you free, not make you a new job.
Thanks again for joining us, Henry. And for those in our audience, make sure to register for upcoming live webinars and check out our library of on demand content made available through the Learning Center on Webroker and on our TD YouTube page. Until then, see you all next time.